Most investors believe that if a stock is cheap, it must be worthless. But that's not always true. Right now in the US stock market, there are companies trading for under $5 a share that sit at the center of major themes like gold, uranium, and cutting-edge medical research. Some of these stocks move quietly for months, then suddenly make explosive moves when the market's attention shifts. Today's video is about understanding why these stocks are being watched, what's actually driving their prices, and what risks most people ignore before clicking the buy button. This is not about hype, and it's definitely not about overnight riches. It's about seeing the market clearly. In this video, we're going to break down 5 US-listed stocks that are currently trading below $5 per share using information from credible
with the
and
regulatory
transparent
submission.
sources such as
Good.
SEC
The
filings,
Q3
major
reports
financial
are
data
ready for
platforms, and
sign-off.
institutional market coverage. I'll explain what each company actually does, what sector it operates in, and what's happening right now that makes the stock interesting or dangerous. Stocks under $5 are often labeled as penny stocks, and while some investors avoid them completely, others actively track them because they can offer outsized moves when conditions align. The key is understanding the difference between low price and real value. Before we start, it's important to set expectations. These stocks are high risk by nature. Many of them are unprofitable, highly volatile, and sensitive to news, commodity prices, or clinical trial results. That means they can rise quickly, but they can fall just as fast. Nothing in this video is financial advice. This is purely educational content designed to help you understand how the market is pricing these companies today and what factors you should research further on your own. If you stay until the end, you'll also see how these 5 stocks compare to each other and which types of investors typically follow setups like these. The first stock on our list is i-80 Gold Corp, ticker symbol IAUX. This company operates in the gold mining sector, primarily in the United States, with assets focused in Nevada, one of the most mining-friendly regions in the world. Unlike early-stage explorers that are years away from production, i-80 Gold positions itself as a company moving toward building a mid-tier gold producer. That distinction matters because the market often values producers differently from pure exploration plays. What makes IAUX interesting right now is its relationship with the broader gold market. Gold prices tend to attract investor attention during periods of inflation concerns, geopolitical uncertainty, or when confidence in fiat currencies weakens. When gold prices rise, mining stocks can sometimes move faster than the metal itself because investors anticipate improved margins and future cash flow. i-80 Gold has also shown relatively strong trading volume compared to its share price, which suggests that both retail and institutional investors are actively watching it. However, this stock comes with clear risks. Mining is capital-intensive, and companies like i-80 Gold often need to raise money to fund development, which can lead to share dilution. Operating costs, permitting delays, and fluctuations in gold prices can all impact profitability. A low share price does not necessarily mean the company is undervalued. It often reflects uncertainty around execution. For investors, IAUX represents a leveraged bet on gold prices combined with management's ability to efficiently bring mining assets into production. It's not a safe play, but it is one that closely tracks macroeconomic sentiment. The second stock is Ur-Energy Inc., which operates in the uranium and nuclear energy space. Ur-Energy focuses on uranium mining projects in the United States, positioning itself within a sector that has regained attention as governments look for stable, low-carbon energy sources. Nuclear energy, despite controversy, is increasingly being discussed as a necessary component of long-term clean energy strategies, and uranium demand is directly tied to that narrative. URG's appeal largely comes from this macro trend. When sentiment around nuclear energy improves, uranium-related stocks often see increased interest, even if the companies themselves are not yet highly profitable. Ur-Energy has historically experienced sharp price movements based on uranium price expectations, government policy discussions, and supply concerns. Its relatively low share price and high daily trading volume make it a frequent target for short-term traders as well as long-term thematic investors. That said, the risks here are significant. Ur-Energy has struggled with consistent profitability, and its performance is highly sensitive to uranium spot prices, which can be volatile. Regulatory oversight, environmental concerns, and long project timelines add additional layers of uncertainty. There's also the risk of dilution if additional capital is required to sustain operations. URG is not a stock driven by quarterly earnings strength. It's driven by expectations about the future of nuclear energy. Investors considering it must be comfortable with patience, volatility, and policy-driven price swings. The third stock is Marker Therapeutics, a small biotechnology company focused on cancer immunotherapy. Marker Therapeutics is working on treatments that aim to train the body's immune system to recognize and fight cancer cells more effectively. This places the company squarely in the high-risk, high-reward biotech category, where stock prices can move dramatically based on clinical trial updates. What draws attention to MRKR is its potential upside if its science proves successful. Biotech investors often look beyond current revenue and focus instead on clinical milestones, trial results, and regulatory progress. Marker Therapeutics operates at an early stage, meaning its valuation is based more on expectations than current financial performance. Even modestly positive trial data can cause sharp price increases in stocks like this, especially when the share price is already low. However, this is also where the risk becomes very real. Most early-stage biotech companies never successfully bring a drug to market. Clinical trials can fail, timelines can stretch, and funding needs can lead to dilution. Marker Therapeutics currently generates little to no revenue, and its future depends heavily on external funding and regulatory approval. For many investors, MRKR is not a long-term set-and-forget investment, but rather a speculative position that requires close monitoring of news and filings. It represents the biotech reality, huge potential upside paired with a very real chance of loss. The fourth stock is Lantronix, ticker symbol LTRX, a tech company operating in the Internet of Things and edge computing space. Lantronix helps connect and manage smart devices used in factories, data centers, transportation, and smart cities. Even though the stock trades under $5, it's tied to a much bigger trend, the explosion of connected devices and AI-driven infrastructure. What makes LTRX interesting is that it is not just a concept stock, it generates real revenue. As companies invest more in automation, AI, and edge computing, demand for secure device connectivity keeps growing. When tech sentiment turns positive, small-cap tech stocks like this can move fast. The risk is competition and execution. Bigger players dominate the space, and earnings matter. But compared to biotech or commodity plays, this is a tech penny stock driven by business performance, not one headline. Next is Ovid Therapeutics. OVID is a biotechnology company focused on developing innovative treatments for neurological disorders, particularly rare and complex conditions with limited existing options. Neurology represents a high-impact area of medicine, where meaningful breakthroughs can create strong long-term value due to significant unmet demand. Even while trading under $5, OVID continues to attract analyst attention, highlighting ongoing confidence in its research pipeline and scientific direction. The stock tends to respond more to clinical progress, strategic partnerships, and regulatory milestones than to traditional earnings, which is common in early-stage biotech companies. Overall, Ovid Therapeutics stands out as a growth-oriented biotech play centered on scientific advancement and future potential, with the ability to gain momentum as development milestones are achieved. As we wrap this up, it's important to step back and look at what these 5 stocks really represent. Even though they all trade under $5, they are not the same kind of opportunity. Some, like the gold and uranium companies, are closely tied to broader economic and energy trends. Their prices move with commodities, government policy, and global sentiment. Others, particularly the biotech stocks, live and die by scientific progress, clinical trial results, and regulatory decisions. The low share price doesn't make them cheap, and it doesn't make them bad either. It simply reflects uncertainty. Stocks under $5 can be some of the most misunderstood parts of the market. They attract attention because of their potential to move quickly, but they also demand more discipline, more research, and more patience than large, established companies. These are not stocks you buy and forget about. They require you to follow news closely, read filings, and understand why the price is moving, not just that it is moving. Without that, the volatility can work against you just as fast as it can work in your favor. The key takeaway here is simple. Price alone means nothing without context. A $1 stock can be riskier than a $100 stock, and sometimes the opposite is true. What matters is the business, the balance sheet, the sector, and the catalyst that could change the company's future. If you're interested in stocks like these, use credible sources, double-check the data, and never risk money you can't afford to lose. If you found this breakdown useful, take a moment to like the video and subscribe for more market-focused, no-hype analysis. Let me know in the comments which stock you'd like to see analyzed next, or if you want a deeper dive into one of these companies.